welcome to the Deep Dive. Today we're jumping right into the August 2025 Personal Consumption Expenditures Report. That's the PCE data from the BEA.
Right, the Fed's preferred inflation gauge.
Exactly. And our mission really is to figure out why this report, which, let's be clear, showed inflation is still pretty hot, why it actually gave the Federal Reserve the green light, basically, to keep going with its rate-cutting plans.
Yeah, it's fascinating because the key thing wasn't really a specific number hitting some magic target. It was more about predictability.
Predictability, how so?
Well, the data came in exactly in line with what everyone was forecasting. Perfect alignment with the consensus.
Okay, so no surprises.
Precisely. And that stability, that lack of a negative surprise, it removed what could have been a huge roadblock for the Fed. It let them stick to their newer focus on employment risks.
Got it. Okay, let's unpack the actual numbers then and see why that stability matters more than, say, a victory over inflation right now.
Sure. So core PCE, that's the one the Fed watches most closely because it strips out food and energy.
Right, the volatile stuff.
Yeah. That held firm at 2.9% year over year. Still quite high.
And the headline number?
Headline PCE actually ticked up a bit to 2.7% year over year. So yeah, both clearly above that 2% target.
But the key was that everyone expected these numbers.
Exactly. That alignment is everything. Because the figures landed right where forecasts said they would, it calmed investor nerves. You didn't see any kind of hawkish repricing in the markets.
Meaning the market didn't suddenly start betting on more rate hikes or fewer cuts.
Correct. It allowed that sort of dovish pivot, the idea that the Fed is leaning towards easing, which really got cemented last month. It allowed that to just continue unchallenged.
Okay, but there's still a split in the details, right? Goods versus services?
Oh, absolutely. You see goods prices going up, and some of that is likely import tariffs.
Mhm.
The Fed tends to see that as a kind of one-time level shift they can sort of look through.
Not persistent inflation in their view.
Not in the same way as services, no. Because services inflation, that's the sticky part. That was up 3.6% year over year, still running quite hot.
And high services costs point towards
Yeah.
the consumer.
Directly to the consumer. I mean, they're the ones driving demand for services, and right now they're basically propping up the whole economy, but maybe not sustainably.
How so? What's the contradiction there?
Well, look at the report. Personal spending consumption expenditures, it jumped up 0.6% just in the month. That's strong.
Pretty robust.
But personal income only grew 0.4% in the same month.
So spending is growing faster than income. People are spending more than they're making, essentially.
That's the gap, yeah. And the direct result, you see it in the personal saving rate.
What happened there?
It fell again, down to 4.6%.
Oof. So that buffer, that cushion people had, it's getting smaller.
It's eroding. And that's like a ticking clock for the Fed. It signals that consumer resilience is weakening, which increases the urgency for them to do these risk management cuts.
Risk management cuts. Meaning cutting rates not because inflation is solved, but to prevent something worse.
Exactly. To stabilize the job market before those dwindling savings lead to a sudden drop in spending, potentially triggering a recession.
Which is fascinating because the Fed seems to be really prioritizing the employment side of its mandate now. Maybe more than inflation in the near term. Even though Q2 GDP growth was really strong, wasn't it? Like 3.8% annualized?
It was very strong. And yes, that's the pivot. They're looking past strong current data and initiating cuts, or planning to, based on a forecast of labor market weakness. It's preemptive.
That feels like a big shift. Cutting based on a forecast, not on current confirmed weakness.
It absolutely is a shift in their risk management approach. They seem determined to get ahead of a potential downturn this time. And this PCE report, being so predictable...
It just cleared the path, didn't throw up any red flags to stop them.
Exactly. It reinforces the baseline expectation. Everyone's still looking for 2 more 25 basis point cuts this year, 2025. Probably one in October, another in December.
And the market agrees.
Oh, yeah. Futures markets are pricing in something like an 88.6% chance of that October cut. It's pretty much baked in. So the predictable inflation data let the Fed keep its focus squarely on the labor market and avoiding recession.
So to sum it up, inflation's still high, but predictable. That predictability lets the Fed focus on jobs, cutting rates preemptively based on forecasts of weakness, even with recent strong GDP.
That's the gist of it. But it leaves you with a really interesting, maybe even provocative thought.
What's that?
Well, think about the Fed's own projections. Their September Summary of Economic Projections, the CPU, they're cutting rates now.
Right, to protect jobs.
But their own forecast says they don't expect inflation to actually get back down to their 2% target until 2028.
Oh, wait, 2028. So they're cutting now, knowing inflation might stay above target for another 3 years.
That's what their projections imply. It really makes you consider the trade-offs they're making and what that long gap tells you about their priorities right now. Is avoiding recession now worth potentially higher inflation for longer?
A crucial question indeed. Something for all of us to think about.